Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and this is a recording of the Tuesday market outlook session for Tuesday morning. Now, this session is recorded on Monday before the markets open on Tuesday as of Friday's close data. Before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today we'll take a look at the equity indices and see where they currently sit as of Friday's close and what our expectations are for the week. We'll take a look at the fixed income markets. Not a whole lot has changed there, but we are at a pretty pivotal moment that's important for us to pay attention to. We'll cover gold and silver and the commodities and take a look at sector rotation, as we still to see somewhat of a lack of rotation in few sectors trying to dragging the markets higher here. And then we'll take a look at some of the stocks that are breaking out and breaking down in the current market environment. So let's start off with the S&P 500, which remains on this very strong uptrend here, very orderly uptrend, I would say. And if you look at the daily chart, we're very much trading near the top end of the range, actually accelerating a little bit above the top end of the range, something that we've seen from healthcare here over the past few weeks, and we've started to see healthcare accelerate here to the upside. But because we're near the top end of the range, there is a higher risk that you get a pullback towards the channel support here. That would come in around 444 or so here in the current levels. But the primary support level we're paying attention to is here is 435. As long as the S&P 500 stays above 435, we remain neutral to slightly bullish here on the S&P, while short-term and long-term momentum remains fairly strong. What we have started to see here is the NASDAQ 100 has started to outperform the S&P 500 again. So high beta is continuing to outperform the S&P 500, having underperformed quite a bit here throughout the year. We've seen some outperformance started to accelerate here to the upside over the past couple of weeks, but it is fairly overbought here, and I think that we do have a higher risk of a pullback here into the 370 level here or so, and more range bound before this continues to potentially break higher here. And the key level here is that 370 level. As long as the NASDAQ stays above that level, we remain in a neutral to bullish phase for the NASDAQ 100. The one thing that has changed has been the small caps. We talked about the breakout here last week above the 225 level here. It has come back to test this level as support and has held that level. And that certainly is constructive for IWM, the Russell 2000 small cap index, to rally back towards that 233, 234 all-time high level. As you can see, both short-term and long-term momentum has now turned positive. That is, again, constructive for continuation higher here. If IWM can break out above 235, that would complete this consolidation pattern that we have been in for almost 9 months for the small caps market. Small caps has been extremely strong off the November election, and then no performance whatsoever over the last 9 months. Think of it as a resting, and now it could potentially start breaking out here. So this is an important level to start paying attention to. Perhaps we might start to see small caps outperform the broader markets here if it can break out above 235. And then when we look at RSP, the equal weight S&P 500 index continues to climb. This is showing us that market breadth is improving. There is participation here in the broader markets as the S&P and NASDAQ continue to climb, but there is some negative divergence that we're starting to see here form. That certainly puts at risk at least a shallow pullback here towards the channel support. But market, just to put this into context, while market breadth is improving, it is still not quite enough, in my opinion, to confirm the new all-time highs that we're continuing to be in a healthy market rally. That's really the concerns that I still see in the broader markets. But the one sector of the market that has started to break out here that is confirming the major market cap indices moving higher is the FANG Plus Index. This is 10 FANG stocks equal weight index, as you can see recently breaking out above its double top resistance level, coming back to test it as support and potentially moving higher from here. So this is likely the signal that still confirms that the major market cap indices will likely to continue moving higher, especially if we start to see some broad participation across small caps, mid cap, and some of the other indices. But as you can see, the stocks that are trading above its 50-day moving average, we started to see this breakout above this downtrend that it's been in since February or so. But it has climbed here above this 47.5% level, and now it's around 55. So certainly not what I would consider a healthy market for markets to be at all-time highs, but only 55% of stocks are trading above its 50-day moving average. But this ratio continues to improve, and that is what we're looking for. And again, we have sort of broken out from this downtrend here. Not quite enough to confirm a continuation higher here, but certainly constructive towards that 67.5, 70% level here, because if we start to see these amount of stocks participating in the market rally, that certainly puts the market rally here in better health. When we look at the bond market, this is really where we are in a bit of a pivotal moment here. You are starting to trade into a triangle here, and the bond markets can either break higher or lower. And that's going to have some major ramifications on where equities trade. Momentum here is fairly neutral here. The long-term momentum remains bullish. There's no doubt about that. You have this major support level here around 146 that's so far is holding here. And the question is whether bonds will break out higher and continue this upward trend that has been in, that is now consolidating. But this is a very pivotal moment to pay attention to as we start to trade into the apex of this triangle as to which way bonds break out. If bonds break out higher here, that's going to send yields lower. That's going to likely be bullish for the equity markets. But if bonds start to break below 146 again, that's going to send yields higher, and that's going to be a cap, if you will, on the equity market. So very pivotal moment to pay attention to. Gold also at a very pivotal moment here, just shy of the 171 breakout level. As you can see, this has been a resistance level for quite some time. If gold breaks out from this level, that starts to put some major resistance levels here at risk, and puts gold back into potentially more of a bullish trend rather than the long-term bearish trend that gold has maintained over the past almost a year, if you will. So you have this major downtrend here that it's still just shy of testing, and if it breaks out above 171, that would put this bearish downtrend here at risk of potentially breaking higher. But very well, you could break out to that level and continue moving lower here. So this is the kind of like the last level to clear before gold can get back into that 179 and potentially break out from this long-term downturn that we've seen. And we have started to see some higher lows. I made a new lower low here, but if we can break out higher here and make higher highs, that would start to confirm from a price action perspective that this perhaps is a bottoming formation we've seen here for gold. Crude also, as you can see, trading at what I would say another pivotal price action level where we're trading into the apex of a triangle. 66 is the support level here. You have this downtrend that has held so far in terms of crude. So if it continues to trade this and breaks below this level, that would be quite bearish for oil down to the $62 level. But if it can break out here, that would be certainly constructive for oil. So far, the fundamentals here don't look particularly strong for oil. And as you can see, the daily momentum here has turned negative and has been negative for quite some time, remains negative. And that could be, a warning signal that there's further downside here for crude. And then when we look at sector rotation, right now we have 4 sectors that are improving or leading, 7 sectors that are lagging and weakening. So not a particularly strong outlook here for sector rotation. You have technology that was leading is starting to lose momentum here. You still have communications moving towards the leading category. And then you have financials and utilities in the weakening category. Financials making its way over to lagging, and utilities, as you can see, will likely enter lagging here today. You have 4 sectors in the lagging quadrant here. You have industrials and materials actually showing quite a bit of strength here over the past couple of days, moving towards improving. Industrials looks like getting there before materials. And then you have healthcare and staples looking fairly weak here in terms of rotation. Perhaps we might see a little bit of upturn here on healthcare as it does remain fairly strong. And then you have energy, discretionary, and real estate all moving towards leading, with real estate probably just entering leading here later today. So these are some of the rotations that we're seeing, and overall on balance, things look okay. They're not great, but you see a fair amount of rotation here. As you can see, materials, industrials turning higher. You have technology coming lower, and financials starting to come up, but overall not a lot of rotation, mostly just continuing in the same direction and has been for quite some time. So that's really kind of where you want to pay attention to in some of those sectors, such as real estate. As you can see, recently we pointed out this breakout here above this $47 level here. This is very constructive for real estate to continue moving higher, as it has confirmed new highs from a momentum perspective. This is likely to continue to see some strength here for real estate. And I did want to point out healthcare. Healthcare, this is what I was talking about, what looks kind of like what the S&P is currently doing. Healthcare was trading in this particular channel for quite some time before breaking out from that channel, is now continuing to potentially move higher. We're starting to see that same price action from the S&P. And what you have here is this triple top. If we break out from this triple top, that would be quite constructive here for healthcare. So this is one that I think is worth paying attention to on Tuesday's morning market open. You have consumer discretionary showing quite a bit of strength here over the past couple of weeks after weakening quite a bit here, getting all the way back to its all-time highs and potentially breaking out higher here. So this is one also worth paying attention to here for today. And also energy. Energy hasn't traded particularly well, but it is putting in higher lows, if you will. It is also putting lower lows, lower highs as well. So trading into again a bit of a triangle here, and the question is whether it breaks out higher or lower. Momentum is negative here, so from my perspective, this certainly looks like this is going to continue moving lower, but the rotation currently shows some rotation into energy. So this is one that's also worth paying attention to for today. So looking at some of the opportunities here in the broader markets, looking at breakouts, looking at breakdowns, one of the stocks that really caught my eye here is Bank of New York Mellon. Bank of New York Mellon recently broke out above a $53 resistance level, came all the way back to test it as support and bounced higher and accelerated higher here and pulled back to the 21-day moving average. And I think that is a nice opportunity from a risk reward perspective to look for further upside. As you can see, daily and weekly momentum remains positive here. The pullback to the 21-day moving average from a risk reward perspective makes favors to the long side, because if we start to break below 52.5 or so, I would cut my losses. If it can, but I still think this projects well up into the $57, $58 area, all-time highs here for Bank of New York Mellon. So pullback on the breakout, I think, is the opportunity for further upside. We've seen quite a bit of improvements here from the home builders as well, and this is across the board. Lennar, D.R. Horton, even some of the smaller players like Toll Brothers, trading just shy of a triple resistance. Lennar is definitely the strongest of the three right now from a price action and relative strength perspective, and I think this is the opportunity for a potential breakout above that 110 level. Obviously home builders have been extremely strong and have spent multiple times of consolidation before breaking out higher here. And we've seen this again, another consolidation range here for home builders that is potentially at the verge of breaking out higher here. So this is a triple top breakout opportunity. It has not broken yet, so you can be on the more conservative side and wait for a breakout before you get long, or you can try to be more speculative, more opportunistic, and try to catch it before the breakout here. And the pullback below the 21-day moving average, in my opinion, is a potential opportunity to play for that breakout before the breakout actually occurs. Seagate Technology is also holding this major $84 support level here multiple times, bouncing off those levels. I think that very likely you're going to see a revisit back to the $94 level, which is the recent high. And then if it can break back above it, you're off to 102, 106 here to the upside. So Seagate Technologies holding this major $84 level is very constructive. And as momentum has now gained some upside momentum, some positive momentum here to the upside, my preference is to play for a breakout above 94 into the 102, 106 range here for a stock that has been extremely strong during the pandemic, has now consolidated for some time, and is now potentially breaking out. And you can also draw your lines here a few different ways, just on the verge of a major triangle breakout here as well. Especially with positive momentum, I think that this is the type of stock that has that opportunity, especially for a stock that's continuing to grow their EPS and revenues fairly strongly here in the current market environment. And lastly, on the bullish side, APA, oil and gas exploration stock. Largely a range-bound stock, but as you can see, this $18 level is a fairly, I would say, major level that has contended with multiple times throughout the past couple of years. It's now showing some strength here, especially the fact that it's been able to get back above 19.5 and hold these levels. That certainly leads me to believe that there's some upside here for this oil and gas stock into the $22, $23 level here as it breaks above the $19 level and momentum turns positive here on the daily chart. On the bearish side, this is really where we start to see some of the consumer discretionary names, especially some of the automobile stocks, start to show some weakness here. CarMax breaking below this 130, 128 level here. This is a level that has been fairly important for quite some time. It's contended with this level multiple times as support or resistance, breaking above it, breaking below it. Now it's back below it, and so far it has failed to get back above this level. So this 128 level has been a major resistance level. My expectation is that this is likely going to trade back down into that 117.5 range or so. As you can see, daily momentum has turned negative here for a couple of weeks, and longer term momentum is just starting to turn negative here as well, confirming the breakdown below 128 and likely the continuation down to the 112.50 level here for CarMax. We also see Van Eck Gold Miners, GDX, something that we've been talking about for a while in terms of gold. You know, this is an ETF that was in a downtrend for quite some time, managed to break back above this channel here, but is back down into a downtrend here again after breaking out of that downtrend. You could see this multiple ways, but from my perspective, I think momentum is fairly squarely negative here. So the fact that we've tested this level once, testing this level twice, my bet is that it's likely going to revisit back to the $31 level here or so, rather than breaking out higher back into the $35, $36 level. That's my view here. Everyone has their own views. We do have a gap fill here around 34 or so, 34.25. That has remained unfilled, so that very well could be an upside target before it continues to move lower here. There's a few ways to look at this, but from my perspective, the overall momentum here and price action on both the short and long-term charts is clearly here to the downside. So when you have a sharp rally here to the upside, my expectation is that you're more likely to see further downside rather than a reversal higher here. But if we do break above 34.25 or so, then I would say that the downtrend is at the end of the downtrend, and we're likely to now continue moving up to the upside for GDX. Another major player that we've talked about quite some time, you know, for both GM and Ford, is that this is a triangle that we've been watching for quite some time, this $13 triangle that has held multiple times as support, has now broken as resistance. And not only has it broken as resistance, it's come back to retest it as resistance and has now been broken and confirmed as resistance. So this looks like Ford, especially with chip shortages looking like they're going to continue well into 2022, this is likely going to bring Ford back into the $11 range, in my opinion. And you're going to see this across most of the car manufacturers, whether we're talking about GM, Ford, or any of the other major players, even Toyota Motors. We're starting to see this type of price action here, and the break below that 13.5 level, from my perspective, is likely heading lower here to the downside. And lastly, looking at Netflix. So we talked about the breakout here from Netflix last week. So this is not necessarily a bearish play on Netflix, but this is just an observation that Netflix, after breaking out from its 555 resistance level was constructive up to the 590 level, but now that we've gotten up to the 590 level, looking at this chart, my expectation is that you're more likely to see some more range-bound motion between 590 and 550. It could break out higher here, but my expectation is after such a big move from 510 to 590 in such a short amount of time, you're likely to see some consolidation. Perhaps it doesn't pull as far back to 555, but you're more likely to see some consolidation rather than just a continuation higher here. Because after such a big move, you need to see some consolidation. You need to see some equilibrium before it can potentially have the momentum to continue moving higher here. So that's really kind of where I'm thinking more neutral, slightly bearish view here for Netflix over the next few weeks. And if we start to see it break out above 590 on substantial volume, that would be the confirmation to continue moving higher. I would not advise against chasing this, looking for that this will continue moving higher in the next week or so. With that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where the current markets currently sit and what my expectations are for this week. With that, thank you so much and have a great trading day.